Fitz-Gerald Group Principal Keith Fitz-Gerald, Nicholas Wealth Management President David Nicholas, and Amerivet Securities Head of U.S. Rates Greg Farinello. Gentlemen, great to see you all. Thank you so much for being here. Keith, kicking it off with you. What do you make of Bitcoin? We've talked about Bitcoin a lot this year, certainly. It is lower, dipping below $40,000 after the China Banking Association has warned its members that there are risks associated with digital currencies, telling them to, quote, resolutely refrain from conducting or participating in any business activities related to virtual currencies. Keith, your thoughts?
Well, I tell you what, the story is never what you think it is. I've spent a lot of time in mainland China. China is trying to digitize the yuan. They are going to weaponize Bitcoin against the United States. Telling banks that they shouldn't be doing it is because they don't want competition. This is an extension of the Jack Ma Alibaba clampdown, and it is a serious development in the Bitcoin world. The United States government has a very, very narrow window to get ahead of this.
I'm glad you mentioned that it's not what it seems, you know, Keith, because this is important. The Communist Party is trying to undermine the United States in this area. Yes. It's just one more area that the CCP thinks that China will rule and be number one in, along with quantum computing, along with AI. Yep. Do you see this as a major risk for the United States?
Without question, I think it may be the single largest strategic risk we have, because they could easily mount a financial attack that populates volatility throughout our financial markets and use all of the computerization, all of the transparency, and all of the ease of access, the casinofication that we've enjoyed against us.
Yeah, it's a great point. David, let's talk about the main story for investors today, and it's retail earnings. Lowe's and Target among the big names reporting this morning, both beating on the top and bottom lines. We've got Target trading this morning up, as you can see here, 3.25% on the better than expected numbers this morning. The comp store sales were up big, revenue and earnings above expectations. Lowe's is down this morning by almost 2%. What's your take on the state of retail?
Well, absolutely, Maria. I think retailers should probably send a thank you note to the federal government, because consumers are just flush with cash right now. You've got consumers that have money to spend. Generally, we have an upbeat, optimistic consumer. That's bode very well for retailers. I mean, whichever name you look at, whether it's Home Depot, Macy's, Walmart, they've all blown out earnings. If you look at some of Target's numbers, I mean, those numbers were absolutely blowout, right? Beat on top line, earnings per share, $3.69 versus $2.22 that the street was looking at. Same source sales were really impressive for me, up over 22%. So, I mean, these numbers are hard to argue with, but I think right now, the consumer, you have a consumer that's very healthy, but also you also have a consumer that's exhausted. And what I mean by that, if you look at the last year, consumers have been pent up with money to spend. They haven't been able to go out, visit, see their friends. I think consumers at this stage are saying, I've got money to spend. I'm ready to get back to my normal life. And that's boding very well for retailers. I don't think that trend is going to stop anytime soon. So if you're optimistic about the future of the U.S. economy, you're buying retail today.
Yeah, I think it's a great point, and retail certainly is emblematic of what's going on in the macro story. Greg, interest rates continue to be at rock bottom levels, but the 10-year Treasury yield topped 1.66% this morning ahead of the Federal Reserve minutes. Is this informing us of any expectations from the Fed? You've got the 10-year now up 2.5 basis points as inflation fears continue to grip investors. What are your thoughts on the Fed minutes, and how concerned are you about inflation?
Sure. Good morning, Maria. Yeah, let's talk about the 10-year first. This morning, we are getting a little pressure out of Europe. We've seen the inflation numbers there. So we still see the buckets really as jobs and inflation. U.S. rates are not really getting enough attention. If you look at the range short term, we had a weak employment number. 10-year yields traded in and around 148, and then we backed up toward 168 into the CPI numbers. So we still think short term. We've obviously had a massive repricing this year. Fiscal stimulus, more Treasury issuance, inflation expectations, vaccination, broader reopening. We had a widening of real yields. Now we're seeing a tightening of real yields again as the Fed continues to influence the nominal market and inflation expectations creep up on the long end. Our view on 10-year rates still heading higher over time. Short term, though, we are in a bit of a holding pattern, if you will, as the market tries to disseminate this information and balance out jobs versus inflation. In terms of the minutes, you know, we came out of the Fed meeting April 28th. with Chairman Powell saying not thinking about tapering. So the market is really focused, I think, less on rate increases, moving off that zero lower bound, and more what this means for asset purchases short term. So in terms of the minutes today, we do expect some dialogue and discussion about the short end of the curve. We've had this plethora of cash on the short end, which has challenged the Fed's zero lower bound. There's talk that they could move some of these administered rates off zero to try and nudge those rates from going negative, in some cases with T-bills they have. And then discussion around substantial progress, right, relative to price stability, employment, the Fed's mandate in terms of what it would take to actually move away from their current policy with regard to asset purchases. If you listen to the Fed speak, though, Maria, and the minutes will be a little bit in the rearview mirror, if you listen to the Fed speak, even despite the higher CPI print last week, they are still sticking to the script. The market doesn't like it, that inflation is going to be transitory. On the employment side, certainly the number that we saw earlier this month, gives the Fed a little bit of credibility in terms of saying, look, we're still a long way from our goals. So we still expect to see that coming out of the minutes. It would be consistent with what we've heard since the last Fed meeting. And we really think, in our view, it's the jobs numbers here going forward that really moves the needle for the Fed.
Yeah, I see Keith shaking his head there. Let me just point out the dollar is down this morning and gold is near a 4-month high. Keith, you want to comment there real quick?
Well, I was just going to say, everything that our prior guest just said, I agree with 100%. Brilliant analysis. Love it. But I think the word Fed and respect in the same sentence is a challenge for me, because I think they've missed the boat. They've already caused the next 3 or 4 crises, and they do not properly understand the effect of liquidity. So their actions today are all going to be about stay the course, as opposed to addressing the real gremlin, which is the inflation we feel in our wallets. Never mind the official statistics that are more cooked than a Christmas goose.
Whoa. Yeah, we'll see. I mean, oftentimes it's the language that moves markets, right? We'll see if the language changes today. Keith Fitz-Gerald, David Nicholas, and Greg Farinello. Great to see you, gentlemen. Thank you so much. Have a good Wednesday. Much more.